All right, so we're getting the pullback over the last 2 days that we've been looking for the last couple of weeks. What are we going to get next week now? Are we going to bounce off of these with these long lower shadows yesterday and today? Are we going to get more weakness? I'm going to break down what I expect using the market forecast and other technical indicators. What's driving this action? How does that impact future expectations? And how can we trade a market that's got a bullish trend in one direction and a pullback going on currently in the other direction? I'm going to talk about that with tonight's trade idea. So let's go ahead and get started. Today is Friday, October the 5th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight or this weekend, depending upon when you're watching it. Welcome to those of you who are watching us for the very first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over that logo right there. Then click the red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me two things. It tells me, number one, you liked the video tonight, you got something out of it. It tells me, number two, that you want us to do the video again on Monday. Really quick, simple, one-click way to give us feedback. You can do that right now while you're watching. Comment on anything that stands out to you from tonight's video. Join our daily Market Outlook email list. There's a link in the top right corner of your screen. Click that link to subscribe. Also, follow me on Twitter for more content like this throughout the day, throughout the week. And of course, join our community of market scholars on Facebook or on our website on marketscholars.com. All right, well, let's start off taking a look at the S&P 500 first on the with the market forecast indicator. You can see we got a second consecutive day with a long lower shadow coming right into this support area. I've got that blue line drawn right now at this old high from January. It's kind of, in between this 23%, 38% Fibonacci levels. You can see a couple of touches in this area. You had a high there. It paused there with a near-term low and here at the bottom. And then you had another touch right here in early September. So there's some support there. There's obviously stronger support below at 2850. And probably the strongest out of all of it at 2800. Lots of multiple intermediate highs touching there, Fibonacci support touching. There's volume support there as well. So we're getting a pullback right now. We've talked about getting this dark pink shading for how long? With all these signs of weakness. And for those that Market Scholars subscribers, the premium subscribers, today's technical analysis class, I broke down the market forecast indicator in terms of time frames and expectations pertaining to each of these lines, and kind of talked about why I was seeing, I've been talking about these signs of weakness for a while. The trend's obviously still bullish, and we are getting a pullback, but because of these signs, we've been expecting an intermediate pullback, which is the dark pink shading, that happened sooner rather than later for a couple of weeks. And today those signs are finally manifesting. At least the last couple of days, they're manifesting. Not that we're significantly bearish, right? They were more bearish than some of these other indexes. If you look at the Dow, you can see the same thing, long lower shadows. We did not break down below that near-term low point right here. That corresponds to that bearish low point. The S&P 500 and the Dow avoided having their short-term sentiment lines drop into the reversal zone because of the late rally in the last couple of days. The NASDAQ Composite now has joined the Russell 2000 as the two of the major four indexes that has dark pink shading. So again, a good sign that we'll most likely get it on the other two as well. Here we go. Right now we're sitting at the 50% Fibonacci retracement level, which lines up with the previous intermediate high point right here. So right in that area. There's the previous intermediate high before we had that dark pink shading. And so now here's the current one that we're coming down from. And so far as of right now, sitting on support at Fibonacci support. Find the Russell 2000. The Russell 2000 is actually broken below both of its last two. So here's the last intermediate low. We've broken below that one. Here's the one before that. We've broken down there. And you can see here's the highs from back in this area. So if I were to draw another, here, let's move. You can see, well, let's leave that blue line there because it lines up with this Fibonacci retracement, 162% retracement. So you can kind of see where the possibility of, of how much further this pullback can go down to 1600, which happens to line up with the top end of these two intermediate high points, kind of this triangle that we broke out of in the spring. So strong bear, and this actually had a cluster today, had a cluster last couple of days actually, and we avoided with the long lower shadow. Remember, long lower shadows are bullish. When you look at them on the charts, long lower shadows tend to be bullish, and we've got them on all the major indexes at or near some support levels. I would prefer if we get that dark pink shading on the Dow and the S&P. See, the Dow doesn't even have light pink shading. It's still strongly bullish, so we're still not getting enough of an exhale yet in the large cap indexes to really feel confident about a sustained move into the end of the year without this happening like what we got last year, where we never got the exhale. We kept breathing in, and then whoa, big exhale to flush all that extra out. So it would be nice, it'd be more orderly if we were to get dark pink shading, if we were to get, even if we weren't, even if we did something like here on this pullback where we got the long lower shadow, or excuse me, over here on the last intermediate pullback where we got the long lower shadow, but then we traded around there for a few days, and that's what brought the intermediate line down finally. So maybe we trade around here in this area for a few days into early next week to get that intermediate line down again, then where we can bounce off support, even if it pulls back to 2850, but where we can bounce off support and then start to make a run higher. All right, a reminder, those watching our Market Outlook on the blog, on a Market Scholars blog, you can get there going to marketscholars.com, then click on blog at the top of the page. Scroll down here, you can see the video. This is probably where some of you are watching it right now. Remember, you can communicate with others in the Market Scholars community regarding the Market Outlook tonight and over the weekend right here in the forum. To participate in that forum, it's free. You can just come up to the top right corner and click on this icon that will take you to a page where you can subscribe to our site. If you want us to do these videos again, Monday, Tuesday, next week, and just keep doing these, the way that we know is by seeing the numbers next to these boxes, right? How many people like the tweets, how many people like the Facebook posts, and how many people like it here on the blog. So the way you give us feedback on this is with these three clicks. Click on that heart, that takes you here, and hit like. Click on this image, it takes you to your Facebook page where you can like a Facebook post there, and then click on this icon. Remember, you can also share. If you feel like other people should check this out, one click and you can share it on any of these platforms or through email. And remember to let them know that they can subscribe and become part of our community for free just by going to this box in the top right corner. As you can see, most intermediate pullbacks do test the 50-day moving average, not necessarily the 200. I don't think we're going to test the 200-day moving average anytime soon. Of course, anything can happen. We saw that here, but we're just not as extreme right now as we were back here. We should have come down and had a red arrow on the 50-day moving average right there, but instead we continued higher, and boom, that's what could happen right now if we don't get another week of weakness towards the lower end of this week's range that gives us a red arrow here on this line and brings that intermediate line down on the S&P 500, and then we can bounce off that level. You can see the MACD is rolling over. If you look again at some of these intermediate pullbacks, nice orderly pullbacks, the MACD rolled over on these too, and then you can see how flat it was as we continue to rise higher there. And then we had another intermediate pullback, roll over on the MACD, and then as we rallied higher to this point, you can see the MACD turned around. So just because it's rolling over from high levels. Again, it typically grinds towards zero through a series of lower highs and corresponding higher highs in the index. Then we look for the sustained moves below the 200-day moving average. Doesn't look like we have that anytime soon. You can see the Dow Jones Industrial Average, long upper shadow, a little bit of a bearish pattern. There's your NASDAQ Composite. Remember, it does have the pink shading on the market forecast. We do have the bearish posture there. and then the Russell 2000 has dropped to the 200-day moving average. So considering that none of the other major indexes are that bearish, similar to what we see even over here. Remember on the S&P, back in July of 2017, that's what the S&P looked like, just barely getting below the 50 and rallying. The Russell 2000 back in July of 2017 hit the 200-day moving average before bouncing and rallying into the end of the year. So just because we're down here this far doesn't mean the S&P will get down there too. We've seen before, even back here in April. There's the April pullback right in this area. You can see we had more arrows on the Russell, and we had just a little dip on the S&P 500. If we take a look at the 3 green arrow chart, you can see we got 1, 2, 3 red arrows on the MACD and the stochastics and the moving average. If we look at the 2-line version, you can see really quickly for future reference here, we had 2 times the average range, so we're at 4 points. We were just under 4 points yesterday, over 4 today, and then the volume, like yesterday, over 100 million again. So so I don't think, again, it's not extreme to where I expect us to bounce immediately back up. But we are bearish enough that we can, but the levels are at bearish levels where we can expect more weakness, probably just not as big as these last couple of days, but more towards the lower end here. Finally, let's look at the 2-line versions. No, excuse me, it's this one right here. You can see the MACD and stochastics are both still in the upper half of their charts, falling, but still in the upper half of their charts. And again, the last intermediate pullback we had right here, that's what happened to these indicators. So that's that appears to be the mode that we're in right now. The stochastics is as low as it's been all these other times. The MACD, however, is lower. So, it's setting up for that intermediate low point, similar to what we had here, similar to what we had right here. If we take a look at the intraday chart, and again, like yesterday, lower high, lower low, we hit the 4-week low point. In fact, we produced a new 4-week low point. There was the old one that we were pretty close to moving anyway, because it was falling off the end of the chart here. So we got a new 4-week low point that obviously we will not be moving that one down, or excuse me, we won't be moving that one up for a while. We can obviously move it down if we were to continue to move lower. The high point is stuck where it's at. So we are in the lower half of the chart. We fell down below the purple line there, which happens to line up with the midpoint of the chart, which is where we were trading early this morning. Fell. That's the open of the Hakinyashi candle on the weekly chart. So if I were to go back to the weekly chart and change here to a Hakinyashi, you can see we had a bearish candle. We had a upper and a lower shadow, very small range. Again, sign of weakness that this bullish move is ending. Again, I expect at least another week of bearishness before we get a bounce. At least. I could be wrong. We could bounce next week, or we might just continue down because anything could happen. But just based on the patterns, I would expect another week of bearishness towards the lower end of this week's range. So go back to this chart. So nope, this one right here. So towards the lower end of this range, if I were to zoom out a little bit, let me go back a few more days. So probably, in this area here between 285, where you have some Fibonacci support and up there, I expect us to have a week around in that area before we find some footing and support. And where, again, all these major indexes are trading at or very near some important support levels. All right, so if I take a look at this chart, so again, remember we had a 4-point range that's in the bearish zone. So again, not extreme enough to cause a bounce immediately, but high enough to bring the line up. So that's bearish. 100 million again is not extreme. It's not outside the 52-week range, but it is high enough to bring the line up. And if you can see, 1% move right now is 2.87 points, and we've had almost 4 points 2 days in a row. So we are in, this line's moving up and has potential, if we were to get above 1, to be bearish for a while. So the question is, we've risen up here before. In the last pullback, we got close to 1, before kind of finding our top and rolling over. Again, that would be the expectation going forward here too. And I don't think it's going to be Monday. I think we'll still have some bearishness, some dojis, and trading in this area here throughout the rest of next week. All right, now let's finally take a look at the volatility chart. This one first, the absolute value, getting all the way up in the upper teens. Again, the last intermediate dip we had also got up in the upper teens. So that's the VIX here. We did close, but because of a pullback down to 1482, I think there's opportunity to still get a little bit higher on that. And you can see we're not extreme on the volatility either, because on a relative basis down here at the bottom, with today, even with at the peak, we were in the bearish territory, but not extreme, not above one. We're not even above 1, much less 1.05, which is where the extreme zone is, and we pulled back into the neutral area. So we actually still have potential for more pullback. I'm not saying that we should be worried at all or concerned. In fact, I've said many times that a pullback like this was coming, and when it does happen, we should not be concerned. And nothing about this sell-off has changed that fact yet from a technical perspective. And the fact that they have not been extreme moves in either size, volume, or range or volatility suggests that, again, there might still continue to be weakness. It might not be as big as what we've seen today or yesterday on an intraday basis, but still enough weakness to continue with the pullback like we already have on the NASDAQ and the Russell to get the large cap indexes to that point too. Hit the support, set up a solid base, and a better launching pad to finish the year with. So to summarize, I think I've done a pretty good job summarizing throughout this chart. The long-term trend is still intact. We are in the process of an intermediate pullback, as evidenced already on 2 of the 4 major indexes. We've had bearish days the last couple of days, not extreme moves that would suggest that we can bounce immediately, but bearish enough moves to suggest that we can continue to get some pullback into next week coming out of this jobs report and this big move higher. We've had some extreme moves this week in bond market, as you'll see here in a minute, and small cap stocks. We'll see if we don't bounce back some of these extreme moves and then see, okay, are these breakouts going to hold, or are they instead just fake outs? So, but in the meantime, we are setting up opportunities for new trend trades to occur as this pullback develops and eventually when we bounce. So that being said, do you agree with that? Do you disagree with that? Let me know with that poll right there in the top right corner. One click on that link, and then just click either agree or disagree. If you just click on disagree, I'd love to hear your thoughts. What you're seeing, what charts you're looking at that would suggest something different than what we talked about. Scroll down to the bottom of the page and share with the market scholars community whether you are, or why, or how you are more bearish than what we are, or if you're actually expecting a bounce a little sooner than I am. So share your thoughts down below. All right, let's take a look at what's driving the price action today. So this is, remember, from the open. This does not include any overnight moves until we can figure out how to set this starting value to yesterday's close. But as of right now, you can see just today, the drop in EEM, the drop in S&P 500 and small cap stocks and developed markets. So all your equity classes down here. Oil was able to maintain bullishness. You can see commodities in general, in fact, they stayed higher. Whereas you have preferred stocks here with gold and there's crude oil, and then the dollar, US dollar, all your safe haven trades. In fact, if you come over here, this is this week, the last 5 days, you can see it's not been a good week for long-term bonds. It's not been a good week for growth stocks, small cap stocks, mid cap stocks, developed markets. Large cap stocks, high yield bonds, all with the biggest. Here, thought I had these zoomed in. There we go. And emerging markets, all with the biggest losses on the day. There's investment grade actually dropping. On the other end of the spectrum is a good week for commodities, agricultural, crude oil, gold. you name it. And MLPs benefiting as well. You can see value stocks and dividend stocks held up pretty well, as well as the dollar. So you can see, there's rotations in place, and that was a rotation this week. It was a sell-off week, especially in small cap versus the S&P 500. Look at the discrepancy between those two. And I've shown you before the relative strength line for the small caps really dropped this week relative to the S&P 500. You can kind of see it here. This is the last 5 days. Again, they open on Monday. It does not include Friday's close, so that's why the numbers are off a little bit. But you can see how IWM really diverged all week. In fact, it started the week bad. It started to bounce back up and then really pulled away here and had a pretty wide difference. But so did long-term bonds. Look at long-term bonds down here along with preferred stocks. And then again, commodities and gold and the dollar were the only ones to finish the week with a positive gain. Of course, the biggest news of the day was the employment situation coming in below expectations, but also there is expectations, but also the higher number here, 70,000 were revised higher from the last number. So 50,000 roughly under the estimates, but 70,000 gained, and as a result, the year-over-year figure for jobs growth is still rising. So a much smaller number here. But this one went up from, see, it was about right here where my cursor was. So it rallied up that much. So it's bringing up that line. So very good sign. You can see the unemployment rate dropping to 3.7% now. So a good strong number there. It actually brought the economic surprise index up. And this yields usually rally with this, and as we've seen, right? And there was some chatter about the yields rising and how bearish that is for the markets. But remember, if I were to look at here, I got this chart from Y Charts over here. Let me bring this over for you. You can see this is the yield spread. The yield spread had dropped all the way to 18 basis points at the end of August. Since then, we've almost doubled. The yield's now, granted, low number, small number, so it's not much to double. And we haven't gotten above that high point that we had in July, but still you can see the yield spread's rising. The reason why the yield spread's rising, normally the yield spread rises from these low levels because the Fed lowers rates. The Fed's not lowering rates anytime soon. The Fed's still in a nice good pattern of raising rates. If I were to come over here, you can see a nice good pattern here of, they're still expecting 60% chance of roughly of a rate hike in March. So we're still at a nice gradual pace for rate hikes. So the Fed's not, this isn't rising because the Fed's lowering rates. It's rising because long-term rates are rising faster than short-term rates. And again, long-term rates are more impacted by economic growth expectations, which you see are still strong, versus inflationary expectations, which impact the shorter-term rates. When short-term rates rise faster than long-term rates, then that's a reflection of higher inflation expectations compared to growth expectations. That's where the Fed raises rates more aggressively, and the yield spread will typically drop when those short-term rates rise faster than the higher rates. So the fact that the yield spread here is going up is a sign of positive sentiment right now towards economic growth expectations. If you take a look at the foreign markets here, I've changed the watch list over on the left. This was a good week for Brazil, and it wasn't a good week for anybody else. Canada and the U.S. held up well, considering how bearish it was this week. Held up much better than the rest of these. Japan, Germany, Italy all had twice the loss that the S&P did. But look at China, look at South Korea and India. And India has been getting oversold clusters day after day after day after day. And Italy's getting one today. You can see how bearish Korea is down towards its 3-month lows. Germany is again at its 3-month lows. So from a relative perspective, there had been quite a bit of improvement in a lot of these areas. But right now, there's been some pullback, and this week has been a bad week for emerging markets in general, and the S&P, as bad as it's been, has been holding up pretty well. Okay, it's also been a bad week for technology, discretionary, and the new communication services sector. I don't know how much longer I'm going to keep calling it the new sector, but as of right now, still relatively new. Also, real estate getting beat up a little bit on the other end of the spectrum. Utilities benefiting, rallying on the increased risk aversion, not rallying on higher rates. That's what's pushing real estate down. Financials benefiting. It's been at the bottom end of the sector selector rankings. That's why it's down here in the bottom right corner. It's the worst performance. You can see materials also struggling, even with some move higher in gold. But industrials, healthcare still have some outperformance relative to the S&P 500. But these energy, industrials, and we would expect materials at some point to bounce back up. But they're holding up. And then there's healthcare with a small pullback, much smaller compared to technology, communication services, and especially discretionary and even materials. That's where your big pullbacks are. Real estate really struggling with the rise in interest rates. So the market's moving away from that area into other areas right now. All right, with the pullback today and then an expected weakness in the short term and eventual bounce, that kind of doesn't give us a clear direction for any specific trend trades or any even short-term swing trades, especially with earnings seasons coming up. You can see a stock like this, Nucor, has been in a sideways range through multiple earnings, and you can see that we've had 1, 2, 3 earnings, and we've stayed within this range where these blue lines are drawn, where most of the volume has taken place. You can see right smack dab between those blue lines, and we're currently in the middle, right around $65, where most of the volume is traded. So I mean, you can't really be, as much as it's 1 year returns is pretty high, and you do have an earnings coming up. We can't be more neutral in the stock like that, even with the upcoming earnings. So of course, one way to trade a neutral stock like that is to say, okay, and what if I were to sell a put vertical below that support, say sell 60 by 57.5, then I can sell a vertical up here on top, sell the 70 by the 72.5, call vertical. So I have two verticals, the calls and the puts, both on either side. You can see the credit I'm getting. That puts there's the trade right there, and you can see the maximum gain with the sideways, with the maximum loss of 189. These slices, which are the break evens, that's what these blue lines are. So the break even slice on the top is at resistance, and the break even slice on the bottom is at support. And we're right smack dab in the middle where the volume node is acting as a magnet right now. We're not really, over the last expiration cycle, we haven't really traded anywhere, really, since over the last two, because we finished this expiration cycle right about where we're at right now. Then we had 1, 2.5, going on 3, and then 4 expiration cycles, but there's some clear support in this area. There's some clear resistance up here, and including volume support and resistance. So in a day like today, and even in a market like we're in right now, where we're bullish, we got a bullish trend, but we are weak in the short term and expecting more weakness, you have to maintain some balance. We can't be too heavily bullish in our swing trade, in our active trading, because we'll get hit on the pullback. We can't be too heavily bearish on our active trading, because it is just a pullback right now. We're not trending lower. So that means that we get balance. In this case, an iron condor, which is what this is called, would be a balance of both a bullish and a bearish trade put together on this stock that happens to be, as from a technical perspective, about as sideways of a chart as you could possibly have. All right, so that wraps us up for tonight. Tell me what you think. What do you think about the market posture right now? What do you think about what's driving this price action that we talked about? What do you think about the trade idea for tonight? Let me know in the comment section below on YouTube. You can also discuss it with other market scholars in our forums with the link above the video on our blog. But I want to hear from you and what you're thinking about this market right now, and any questions or comments you have on what I've discussed or questions and comments on anything I haven't discussed. More than willing to share with you my perspective. So post those questions and comments there in our Market Outlook forum on marketscholars.com. As always, thank you very, very much for tuning in today. Have a great rest of your weekend, everybody. Next week, I expect there to be a little bit more weakness to occur. Probably not to the same extent. There'll be some ups and downs, but most likely trading towards the lower end of this week's range next week. So don't be surprised. And we've been looking for this for a while. We're getting it finally, and everything will shake out as it always does when we get these pullbacks. So have a great rest of your weekend. Thanks for tuning in. Subscribe to our YouTube channel. Click the like button down below. Comment. Follow me on Twitter for more content like this, and join our Market Outlook community on Facebook and on our website. So again, we'll see you all next time.